and you can target the opposite fair value gap low that you see over here. Right? This is the 15-minute higher time frame fair value gap that we saw on the 15-minute time frame to go long if the market traded into it, right? And you can see during our session that we do trade into it. We shift the market structure, but the best ICT London Killzone strategy. For this strategy, we're going to be using the following timing over here, which is from 2:45 till 4:30 a.m. New York Eastern Time. That is your time window to execute trades, which is to say that you cannot execute any trade before 2:45 and no trade can be executed past 4:30 a.m. New York Eastern Time. Now, that doesn't mean that trades cannot run past 4:30, but you cannot execute a trade after 4:30 New York Eastern Time. We're going to be using the 15-minute and the 1-minute time frame. You're going to need to know what displacement is, as we're going to be using it for this strategy. We're going to enter on the 1-minute fair value gap entry strategy that I've shown you in the previous video. We're going to be waiting for a liquidity sweep or fair value gap mitigation. Those are going to be your POIs, your points of interest that you're going to be patiently waiting for in order to execute the strategy profitably. And you're going to be using the strategy on the euro dollar or the pound dollar. They're closely correlated. You don't want to execute a position at the same time on both pairs and the pound yen. Now, with that said, let's go through the diagrams, which should explain the strategy fairly well. Now, the blue box here is your time window to trade. Okay, so any price action from here till here is where you're going to be executing trades. Before this, you're not going to be interested. Now, how do you determine everything that you need to determine in order to execute a trade? Let's go through this. It should be rather quick and easy. Now, you're looking at the 15-minute time frame initially, which is your highest time frame on this strategy, and you're asking yourself this very one simple question. What fair value gap or buy side liquidity, sell side liquidity areas can be traded into during this session? That's the one simple question that you need to ask yourself while trading the strategy, which is to say you're going to look for fair value gaps above the market. So let's say the session begins and it's here. Okay, at that point, what you're going to do is denote for fair value gaps above the market. There could be one here, and buy side liquidity pools above market, which in this case we have a big high right there. That would be you marking out the high here being the, once again, buy side liquidity pool. Now you're going to do the very exact same for the downside, because you don't know if the market is going to move up or if it's going to move down. Okay, so once again, the market is here. You're looking for fair value gaps closest to the market and sell side liquidity pools as well close to market. You would mark the sell side liquidity pool, and once again, we've not drawn the price action, but there could be a fair value gap waiting underneath the market here as well. And that's your job. Once you've done that on the 15-minute, you're then going to be jumping into the 1-minute for the fair value gap entry model, which is to say only once the market has traded into any of the areas, which once again can only be a fair value gap on the 15-minute time frame or a buy side or sell side liquidity pool, you're then going to be jumping into the 1-minute time frame, and you're simply going to be looking for a change in the state of delivery. Okay, we've talked about this concept numerous times. Let's say the market is heading up here. You'll want to wait a market structure shift with a fair value gap, in this case, to go short. This could be the sweep of a buy side liquidity pool or a fair value gap. Those are the only two things that are available for this trade. If you don't get that, you don't have a trade for that day. Now, I know this sounds confusing, or it may sound if you're not familiar with ICT concepts, but it should be very clear as we jump into the charts, where we're going to be covering everything very in depth. We're now looking at the euro dollar on the 15-minute time frame, and just so you know, I'm not cherry picking any particular examples. This is just today's price action. You can see the live market environment here at the time of this recording. And we are going to be going through the strategy on today's price action and run it through it. So what I'm going to ask you to do now is pause the video for a second and annotate the rules that I've given you, which is, once again, you need to mark up the first fair value gap above market and the first value gap below market at the time of the start of your trading window, which is denoted in green. Once again, it is a very concise time window which is necessary to making it work, which is once again 2:45 and 4:30 a.m. New York Eastern time. So pause the video, denote the first fair value gap above market and below market, and the first buy side liquidity pool above market and sell side liquidity pool that you can see that the market is likely to trade into while your session is active. Now I trust you've done that already. I'm gonna reveal this to you. And this is how my chart would have looked like this morning trading this strategy. Now, if we jump now into the 1 minute, which is where we can do our executions, we can take a look. So this is where you come into the charts, 2:45, and this is your time window to trade. And we have our drawings from the 15-minute higher time frame. What do we see? The very first thing that we see is the market trading into a fair value gap. Once again, you can refine this to a 1 minute fair value gap. If you feel more comfortable doing so, you can use a different color in orange as an example. And that could be your 1 minute fair value gap refining, but knowing this is the overall 15-minute area. Now, the market trades into it, moves away. Does it provide a market structure shift with displacement? I would say no. We don't really displace. We hold bullish order flow here and we propel higher. Now at this point, we try for higher. We then shift effectively. We have impulsive delivery to the downside, which is displacement. We have a closure below the swing point here, which we can denote as such. This is your market structure shift. And if you remember, we needed to close below it in order to be valid, which we do. And at that point, you're valid to look for shorts, right? Why? Because we've traded during 2:45 and 4:30 a.m. New York Eastern time into our 15-minute first fair value gap above market. Once again, the market is here when you begin your session. And this is the closest one that we can see on the 15-minute. How do you execute this trade? Very simple. The market confirms itself that it wants to move lower. You enter on the first fair value gap. You have this beautiful fair value gap here, waiting above market now. Right there. You can once again write it down as such. And you can look to go short right here at the open of the fair value gap. You place your stop above a significant thrust. Once again, not the swing, which is a thing that people do, which is very wrong in my opinion, but above, once again, the thrust candle. And you can target the opposite fair value gap low that you see over here. Right? This is the 15-minute higher time frame fair value gap that we saw on the 15-minute time frame to go long if the market traded into it, right? And you can see during our session that we do trade into it. We shift the market structure, but the entry happens outside our time window, which is not a valid trade to take. But you can see how the module performs both and delivers on the sell side and the buy side. This trade could have been taken considering the rules that I've given you. This lower trade is the 15-minute fair value gap, which we do shift, but the entry comes too late and you don't take it. But you would have gone long at a fair value gap. Once again, could have been here. Just giving you the information so that you're aware of how the module would perform when traded effectively. So you could have gone long there. But once again, we don't do this because it's outside our time window. It's 10 minutes too late. You would have then wait for the next session where you do get the sell-off on the euro dollar, and at the same time you could be looking at a sell-off or a trade overall on the pound yen. Okay, you can just not take a trade on the euro dollar and pound dollar at the same time. Otherwise, you're perfectly fine to trade it. Once again, we never trade into the buy side and sell side liquidity pools, but that is fine. That is why we're looking for fair value gaps as well. You're essentially using two areas of POIs for this strategy: the buy side and sell side liquidity pools and fair value gaps. And you're confirming those on the lower time frame with the market structure shift points strategy that I've shown you, I think it was 2 uploads ago. Hopefully this was helpful, and I'll see you in the next video.